Let's say you reach retirement with 5 million rand in your retirement fund. First, you decide how much you take as a lump sum. After that, you must turn the remaining money into an income. In South Africa, you usually have to choose between two products, either a living annuity or a life annuity. These products give you income in different ways. They shape your risk, your flexibility, and what you leave behind. This is the full picture put in simple terms. Living annuities remain very popular. CISA's 2025 statistics show that total assets in living annuities reached 781 billion at the end of December 2024. Life annuities are also gaining interest again. Bond yields and interest rates have increased in recent years. When bond yields rise, insurers can offer higher monthly income. Life annuity payout rates move with these yields because insurers invest most of their reserves in long-term bonds. Both of these products matter. One gives flexibility and inheritance, and the other one gives certainty and a defined income. A life annuity pays you a monthly income for life. You take your remaining retirement money to an insurer. They convert it into a contract that pays you monthly until you die. The insurer carries the investment risk and the longevity risk. You can shape the structure in which they pay you. You can choose a level annuity that stays the same every year, an inflation-linked annuity that increases with inflation annually, or you can opt for a fixed increase such as 5% every year. Another option is a market-linked annuity where your income goes up when the investment returns exceed a set threshold, but the good news is that it cannot go down. A guaranteed period can be added from 1 year to 25 years. Your income will continue to be beneficiary for that period if you pass away early. For example, let's say you have a guarantee of 25 years and you pass away in year 13. For the remaining 12 years, that income will be paid to your beneficiary. You can also add your spouse as a second insured life on the annuity, which means that the income from the life annuity will pay until the last one of either you or your spouse pass on. Most guarantees reduce the starting income because the insurer must fund more protection. A key fact, the monthly income from a life annuity is often higher than a sustainable draw from a living annuity. This is because insurers use long-term bond yields to price income. Higher yields allow higher payouts. A caution, a higher starting income often means lower income growth in the future. If you choose the highest initial amount, your income may fall behind inflation. Your expenses will continue to rise. This creates pressure later in retirement. This decision, moving to a life annuity, is permanent. You cannot change the structure after you move into this. A living annuity, on the other hand, keeps your money invested in your own account. You choose the investment funds and how it's invested. You choose the annual drawdown between 2.5% and 17.5%. You can change the drawdown rate once per year. If you draw 5% on 5 million, you get 250,000 Rand per year. If you draw 7%, you receive 350,000. The balance stays invested and grows. Your beneficiaries will inherit what is left if you pass on. The benefits of a living annuity is flexibility, control, and legacy. The risks are market volatility, timing risk, and drawing too much. There is no guaranteed income for life, meaning your money can run out. Bad timing also matters. If your income is too high in a bad market year, your capital can drop quickly. This increases the risk of, again, running out of money. CISA's latest breakdown shows how South Africans draw from living annuities. The largest group at 30.5% draws between 2.5% and 5%. The second largest group draws between 15 and 17.5%, and that is 19.7% of annuitants. Then the third group at 18% draws between 5% and 7.5%. The 15 to 17.5% group is a major concern. Clients drawing at this level are likely running out of capital unless they have exceptional returns in that specific year. Sustainable income usually sits in the lower ranges up to 5%. Life annuity suits people who want certainty. They suit people who want protection against living a long time. They suit people who prefer a fixed monthly amount that will never need manual adjustment. Living annuities suit people who want control. They suit people who want to leave money to their family. And they suit people who can handle market movements either on their own or with the support of their financial planner. And they suit people who have other assets and income sources. Just again, caution with life annuities. A high starting income with low increases may look attractive at first. Over time, your buying power can fall as inflation rises. The choice should always form part of a holistic plan. Your income must support your life goals. It must support your lifestyle, your health needs, and your aspirations for later years. It must fit into your tax plan, your estate plan, and your long-term cash flow. Aligning your money with your financial plan is more important than choosing a specific product. Both products are tools. The right tool depends on what you want your retirement to look like. Good advice explores the full picture, not just the income product. So, when deciding to choose, here's some useful questions to ask. What income do I need each month? How much risk can I handle? How long might I live? How important is inheritance to me? Do I prefer a fixed or flexible income, or how much flexibility do I need in my income annually? Do I have any other assets supporting me? And what lifestyle do you want to protect? And then finally, what long-term goals do you want to achieve? These answers might guide your structure. Many people also blend the two products. They use part of the retirement money to buy a life annuity for stability, and they use the rest in a living annuity for flexibility and legacy. Another strategy that some people have used is to start with a living annuity and then convert part of it to a life annuity later. Older age often gives higher payout rates because it's a shorter period, and then this strengthens the guaranteed income in later years if you want more certainty. You can move from a living annuity to a life annuity, but you cannot move from a life annuity to a living annuity. So, just to wrap up, a life annuity, stable income, higher starting income, lower flexibility, no capital excess. And then a living annuity, flexible income, inheritance for beneficiaries, market exposure, and no guarantees. The best answer depends on your goals, your lifestyle, and your long-term aspirations. Holistic planning helps you align your income with your life plan. This ensures your money supports the life that you want both now and in the future.